All right, some reporting issues. So earlier we talked about the $23 million in the last set of slides that occurred in 2017 when it revised its estimate of future salary levels. So that was that was a whole screencast back. But trust me, there was a loss, right? Because the idea is you adjusted your PBO up. So with that, you increased your PBO. Here's your credit, and you have a loss from the change in assumption. All right, other comprehensive income. On the flip side, remember that $3 million that I didn't like? That we actually had $30 million of return on the assets instead of $27 million, but we still had to use the $27 million for the pension expense calculation. I don't know why, but for whatever reason, we're now going to record that $3 million increase. So we've got our plan assets have increased by $3 million, and we show a gain. Okay, so rather than the reduction of an expense, instead it shows the gain is in the other comprehensive income section. Again, decision made by smarter people than me. All right, so here are our pieces of the previous problem. We've got 41, 24, 27. This is all of what we talked about in the last set of slides here. Here's what the journal entry looks like. So our pension expenses is $43 million. Our plan assets increased by 27, right, because we're using the expected return, though our plan assets did increase by the additional 3 over here. Okay, back to this. Our PBO increased by the 41 and the 24, the service cost and the interest amount, our obligation. And here's the amortization of the prior service costs and the amortization of the net loss. Okay, so there's all your pieces. Just to show you, I left this here because here's General Mills' example. They do show all the breakdown of all of these things in the footnotes of the financial statements. Okay, so let's say that recording the funding of plan assets, so that how we actually put the money into plan assets. We debit plan assets, credit cash, right? That's the contribution at $48 million. And we pay $38 million to our retired employees. So we reduce plan assets, and we also decrease our PBO, our projected benefit obligation, because it's like reducing the liability. All right. Now, I mentioned earlier that we are underfunded by about $110 million between the PBO and the plan assets. These are all the numbers we've been working with, right? So if that is the case, and I clicked and it didn't go. All right. If that is the case, oh, it doesn't show it, the 110 million. Okay, that's a shame. It's 110 million, right? So you would show it as a liability. You would show the 110 million as a net pension liability versus a pension asset if you had overfunded your plan, which again, not very common, I would think. Okay, back to the next slide. So statement of other comprehensive income. Here's all those other comprehensive income items: the $23 million loss, the $3 million gain, the amortization of net loss, and the amortization of prior service costs. That's where all of those guys show up. To show you, here's the pension. Oh, here we go. That's what I was looking for. The net pension liability, the 110 million, right there. And in the stockholders' equity is where you have the accumulated other comprehensive income items. Okay. Income tax considerations. We haven't talked about the tax effect on these things, though the last chapter was about taxes. The idea is you'd have, right, it would be gains and losses. Well, here you go. Gains and losses are reported along with their tax effects in the statement of comprehensive income, right? So you would report them in line with each other because they're reported as a net item. Okay, there you go. And AOCI, the accumulated other comprehensive income, is reported net of tax as well. Okay, so this, I left this in here, screenshot it, do whatever you like with it, but the idea is this is pretty much everything we covered in this whole section of that massive example. So if you want to print this, it's got to be in your book. If it's in your book, then you could use it to kind of track and follow along all the costs as you go through. The defined contribution, much easier, right? All right, so if you are terminating, right? Let's say you are going from a defined benefit plan to a defined contribution plan, right? That's it. The company decided no more defined benefit plan. We're going to put an end to it. So if that's the case, obviously it needs to be in the financial statements as a footnote. And it says the company, in this case, it was Melville Corporation, which I don't know what they make, but I guess it's a real one because it's a real example. That's what they do in little blue boxes. The company recorded a non-recurring gain of $4 million, which is the amount of plan assets that reverted to the company. So they took the assets out of there, and they went and somehow they purchased the people's annuity contracts and rolled it into a 401k plan. Post-retirement benefits. The end of this chapter is about post-retirement benefits. I want you to know that they exist, that they're paid out, that you need to calculate them. You kind of need to do almost all the same stuff you do for the regular benefits, for the regular retirement funding. It is not quite as complicated, but it's awfully close. more than anything, I just want you to know that it exists, and they do have to pay for them and plan for them in the same ways with discounting the funding, calculating. Some places offer medical coverage, some offer dental, some offer life insurance, right? All of these things have costs, right? And if they're going to be paying for somebody's health care for the rest of their lives, you know how expensive that can be, especially as you get into later years. I will say my mom was a Woodbridge high school teacher for more than 30 years, and she had her medical completely covered as well as her dental for the rest of her life. So there's two different types of plans, right? This is what we're looking at here is post-retirement benefits. So there's retiree health benefits, but also there's healthcare benefits during employees' working years, right? So these are the benefits that are the ones that we're talking about now are the ones that are going to continue into retirement, and this is just benefit. They're just saying that it's different. It's different because it's after the person has been done working for you. Okay, so they're fundamentally similar. Oh, let me go back. They're fundamentally similar, which is what I was trying to say before. You still have to, there's deferred compensation. The employee earns them during the time that they're working. So you have to accumulate the expenses all the way along, the same as you were doing for regular benefits. You're going to come up with the estimate of the present value of the cost of those benefits, and you're going to discount them back to today's dollar. So you're doing all the same kind of things. I didn't want to put you through that level of pain, so I just want you to know that they exist and that you do have to do similar amounts of work in order to calculate what the obligation is for these. And that's what I'm saying. Expected future healthcare costs for retirees must be recognized as an expense over the years necessary for the employees to become entitled for those benefits. A lot of times the one difference here is that for the pension benefits, once they just continue to accrue like in a steady way over the person's employment. But in these cases, a lot of times to qualify for these things, an employee needs to have worked there for, say, 20 years, 25 years, whatever the case may be. So they don't qualify, and then they qualify for all of it. So in this case, post-retirement benefits aren't given to everybody. It's usually based on term of service. All right, and General Motors has something similar. They note it in their financial statement, saying that they do provide these post-retirement benefits to their employees, and GAAP requires that they accrue those benefits over the period of time the employees are working for the company. I think what they've done in the past was simply just when people had them, they recorded them in their entirety, like somebody retired, maybe they didn't accrue for them over the period the person was working, and in their retirement period they would just expenses. Employees would have these costs, and that's not the way to do things, right? If you know that there's going to be an obligation, it makes sense to accrue for it, at least in the world of accounting, right? Just an idea of the kind of things that you're looking at when you're dealing with these things. Estimated medical costs in each year of retirement. How much is the retiree going to pay? How much is Medicare going to pay? And oh my goodness, can you even imagine? And then all the things we talked about in the pension section, right? The defined benefit section, the discount rate, the expected return on assets, how many employees, the turnover rate of employees, when are they going to retire, the expected age of death. So all the same considerations come into play. All right. Okay, that's what we're talking about. Same thing. And okay. And it's referred to as what we record as a liability is the discounted present value of the benefits. So the same as we do now, we discount it back to today's dollars, and that's the obligation that we record. Okay. I hope you enjoyed the pensions chapter. Have a great day.